Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management, and I hope that everyone had a good weekend. And I know so far in the month of September, things have been incredibly panicky in the stock market. We've seen substantial weakness across the board. There's really been nowhere to hide. And I'm recording from the road this week, so I apologize in advance for the lack of video. But what we really want to do this week is really kind of focus on the market-wide weakness. When we look at our own strategies right now, the more aggressive growth strategy has obviously underperformed during that time period. That is expected during market weakness. The blue chips kind of been in line with the broader market, and the income has actually done exactly what it's supposed to do, which is be sort of flat to up in this time period. So what we're going to do this week is focus on what we're sort of calling that red September. Three big things. Has the selling dented the long-term backdrop, right? So in other words, despite the intensity of the selling that we've seen over the last week and a half, and then really the first week of August as well, has anything dented that longer term picture, and should we change track as a result of that? Number two, what are the reasons for the selling that are taking place in the stock market? And lastly, do interest rates suggest a rotation? So we'll go through all of that this week. The first thing I wanted to go through was really look at the percentage of stocks that are in what we sort of call this longer term uptrend. And there are pieces of the selling that bring back bad memories of 2022. We're cognizant of that, of course. But I do want to be also respectful of the fact that the underlying backdrop is structurally different than what we saw in 22. So in 22, we saw a sharp deterioration in the percentage of stocks in an uptrend leading up to the crescendo of the market, and then follow through as the market continued to sell down. This time around, we have over 70% of stocks that remain in a long-term price uptrend, but most importantly, that number was rising into the intermediate peak that we saw here in the S&P 500, really back in early July. And so, this really provides us a guide as to whether we want to de-risk the portfolios or wait out the storm. So right now, based on this and based on a few other factors such as how those economic reports have been coming in, we've made the decision to wait out the storm. We also see that in our corporate bond portfolio where prices have actually been going up, not down. So that suggests that corporate credit spreads remain well behaved. So as a result of that, that's really the reason at this point to sort of stomach the pain that we've seen in the last week and a half. And of course, if anyone has questions on, if there are any stocks there that they may want to sell, give us a call. We can go through everything, but we do want to be, we want to make sure that as markets go through, again, the month of September always seems to have these types of moments, that we're bringing people into the conversation. So why did the market tank last week? A lot of various different reasons that prognosticators are throwing out there. One big reason for Friday's weakness in particular was that, and this is going to sound weird, that the jobs report was not as bad as the whisper number was potentially suggesting. So even though we kind of came in under expectations, the survey was for 165,000 versus 142 expected. 142 is a healthy number when you think of the number of jobs that have been created over the last couple of years, even adjusted for those negative revisions that we saw a couple of weeks ago. 142 is not bad. But the problem for the market is they've all been kind of waiting for these rate cuts. So the probability of a 50 basis point rate cut went from about 65% to 27% on that report. So in other words, good news was bad news. Now, regardless of that, interest rate cut is still going to happen in September. We just don't know if it's going to be 25 or 50. And I think part of what the market might be worried about is that the Fed doesn't go on 50, that they could make a policy error and that the economy could be weakening faster than expected. We just don't see that in the data right now. That's not to say that the data isn't lagging and that the market might be sniffing something else out. But when we look at even within the stock market of what's been doing well this year, such as the banks, again, you don't tend to see that type of price action ahead of recession. So So again, that's kind of what makes us hesitant to, hit the panic button and start selling. So that's a little bit of that. In terms of volatility, another interesting development has been the backwardation of the VIX curve. Now, we've talked about the VIX curve in the past before, but when you go into backwardation, it does suggest that there is this panic into buying protection for the portfolio. In any case, like life insurance or anything else, insurance is more valuable the longer the term is, right? So in other words, you're going to pay more for a 30-year term than you are for that 10-year term. And if you suddenly have prices going up for near-term insurance relative to long-term insurance, that does suggest some level of irrationality. And that's what we saw over the past week is that, if we look at August 31st, this was the VIX curve, very natural, normal. And this is what it was as of Thursday's close. We saw 19.9 on the VIX versus 19.7. This surge also kind of normal. It's the election day. So we've seen that volatility rise above the surge expected for the election, which again suggests that maybe what's happening is some of those election day concerns are just being brought forward. Translation, that could be good. In other words, we're getting that panic selling out of the way. Now, when we look at the economy and we try to determine, is this a contraction or expansion, right? So are we coming into a soft landing or hard landing? We look at all the different economic data points. So whether we're looking at manufacturing PMI, job openings, new farm payrolls, CPI, PPI, new home sales, existing home sales, consumer sentiment, everything across the board is coming in tame. What tame means is that it's not hot, right? In other words, it's going to force the Fed to increase interest rates. It's not coming in soft. In other words, it's not coming in contractionary. It's coming in slower than it was. In other words, a gentle slope down as the economy that was overheated is starting to cool down, but not necessarily, again, going into contraction. And that's the big thing that we're paying attention to is that, is the economy going into contraction? Because a contraction does change the name of the game. And despite the political views out there, whether you're a Democrat or Republican, we're less concerned about that. We're more concerned about what is the data trying to tell us. And right now, I get it, the price action sucks in the stock market, but the data actually does look relatively okay. So translation, rate cuts, right? You're going into a softer economy. The Fed does view, we've used this slide a few times, but the Fed views the neutral rate at around 3%. So right now, the policy goal, as expressed, as communicated by various Fed speakers, is that they want to get to that neutral rates. We see that as 3%. Why do we see that as 3%? That's what the Fed's been telling us they view the neutral rate to be, even though that 3% is, of course, completely academic. So what does that mean? Well, we look historically over the last 10 years, even beyond, it's been very positive for things like Bitcoin or digital assets, small cap stocks, regional banks, commercial real estate, cyclical stocks, so stocks that have higher volatility that are tied to a positive backdrop for the economy. And it has tended to be negative for energy and healthcare. Why? I don't know. Healthcare, probably because it's viewed as a defensive asset. Energy, probably more because it's viewed as a value versus a growth asset. Lower mortgage and loan rates for Americans, that tend to be good for the consumer. And it does benefit smaller companies that need access to capital in order to grow. And then, of course, that also helps companies with lots of debt, right? So if you have a lot of debt at 8%, you can refinance at 5%. That's fantastic for your balance sheet. So those are the areas that we've been positioning in. Now, when there is a risk-off moment like we've had in the last 2 weeks, these stocks do get hit in the short term. I think the mistake that we made in 2022 was abandoning those types of trades. So what we want to make sure that we're doing is being disciplined, going through some of the short-term volatility, and then on the other side, benefit from that recovery. And again, you look at the small caps, they continue to show life. Now, these did retrace this past week, obviously, But what we want to pay attention to, and this is a reason why we brought this slide back up, is that through the noise of the selling, the big events that have actually occurred with the Russell 2000 have been to the upside. These 27-1 or 20-1 upside downside days. These are the moments we want to pay attention to. If this was happening to the flip side on the negative, we would actually want to use rallies to maybe take some off the table, versus I think right now using that weakness to put some more money into the market. That's kind of our overall view. So right now, market price action, bottom line here, it is painful. There's no doubt about that. You know, we're having a great year going into August. That has obviously retraced. Our job now to end the year strong, get those gains back, and get back into growth mode. Number two, the VIX is suggesting that some election day concerns might be getting front end loaded into September. I personally think that's a good thing. The quicker we get this election stuff over with, the better. And then lastly, while the market is painful, we think positioning the portfolio for lower rates does make sense. So that's what we got for you this week. I know last week's been painful, never fun, does bring back memories of 2022. Don't see that in the cards right now. Again, nothing is a guarantee, right? But if you do have questions, we're here to help. And feel free to give us a call, 888-543-3776. Hope everyone else is having a great week, and talk to you soon.